Joining us, Jack Ablin, Chief Investment Officer and founding partner at Crescent Capital, to continue the conversation here this afternoon with us. Jack, good to see you again. So it is pretty tough right now to beat the indexes, but is there any point in trying? I mean, it seems like we should be celebrating the Bogle-envisioned world of investing and just letting it ride.
Yeah, I mean, the passive strategies, the capital-weighted index is certainly the way to go. I did hear some of your conversation. You're right, the dispersion underneath the surface is enormous. Right now, the index relies on about 5 stocks. And yet, only 100 out of the 500 have outperformed the index so far this year.
Yeah, that is pretty amazing stuff. Is this the way it should function generally, Jack? I mean, are these companies just, are we following the disruption, following the profit, following the growth? I mean, is there anything that objectionable about it?
I mean, it follows a pattern. One of the things we look at is the rolling return differential between the S&P cap-weighted and the S&P equal-weighted. And over the last 6 months, the equal-weighted has underperformed the cap-weighted by about 10 percentage points, maybe even a little bit more. And rarely does that happen. There is really only one instance where the equal weight underperformed the cap weight on a trailing 6-month basis by more than that. I think it was about 11.2%. And that was in March of 2000, essentially the peak of the internet bubble. Before things quickly reversed. So I'm not suggesting that we're in necessarily an AI bubble, and certainly a lot of these names are making money. But I do think that the enthusiasm and that safe haven status has really pushed a lot of capital in their direction. And I think they've probably pushed that pendulum a little bit too far, in my view.
Well, it's a good point that the index concentration does harken back to .com, even if valuations aren't quite there yet. It still is an important comparison from that perspective. You guys have a quadrant that looks at momentum and valuations. I wanted to pull this up, Jack, because one thing I see is that it almost looks like tech is in a momentum negative category. But how are you guys measuring that?
Yeah, so what we're doing here is these are rolling 3-month relative valuation and 3-month relative momentum. Normally the tech has certainly been continually outpacing the S&P 500. It's starting to fall below its normal, relative strength. And so you put relative valuation, expensive valuation together with falling momentum, that's a sell. We would rather own cheaper stuff that's moving in the right direction. You can see that quadrant in the upper left with healthcare, financials, real estate, discretionary energy, and even discretionary is starting to push. These are relatively cheap sectors on a rolling 3-year basis and exhibiting some momentum. Perhaps now maybe the investment community is starting to discover these sectors.
It seems like the valuation cheap plus momentum positive category is actually pretty encouraging, that there's some options in there. But do you have to avoid things that depend too much on an economy where data have been just keep coming in disappointing? Economic surprise in the basement.
Yeah, I mean, it's funny. Even though economic surprise in the basement, one of the things that's a slam on real estate is this higher for longer trade. Remember, real estate was probably starting the year one of our best picks for the year because it would be the beneficiary of lower short-term rates, as perhaps now some of these owners could get out from under this debt load and start to refinance, even if it meant going into floating rate. And yet nothing's happened. Now, as we start moving toward the back half of the year, and if the Fed funds futures for September and December hold true, perhaps we will start to see that catch some strength, and we're starting to at least see it in the momentum right now.
Okay. Other factors on the year that have kind of stalled out in favor of growth. We've got a chart from you looking at different styles of performance here, going back a ways. This is showing that basically, there's such a big gap down from growth. But also it's important that quality is right there with it too, right? I mean, that does kind of speak to the nature. Quality is the blue line, growth is the yellow on top, everything else down below. But that is a key part, that quality basically has been right there with it up until what, like the last 2 months?
Yeah, and that's it. I mean, the fact is that what we're seeing is that, financing costs at these substantially higher rates, highest rates we've seen in, 15 years, are really creating winners and losers, and we're seeing that play out in the market. Any company that has any kind of debt burden, or a lower quality company, or companies that aren't generating internal cash flow that can satisfy their growth, is really falling by the wayside. Those companies that can generate internal cash flow and not rely on the capital markets for debt are the winners in this kind of market. So for us, we do like high quality. I think quality is one of the mantras for our strategy. And we think as we start to move into the back half of the year, dividend growers, which are not too far behind. I think dividend growers are in red. Their third category is starting to perk up a little bit. Could be a way to catch a little momentum in the back half of the year.
All right. Speaking of the back half of the year, Jack, again, another chart that looks at the polling odds, and there was a little bit of a murmur kind of building after the debate that maybe some of the bond market swings were tied to predicting who's going to win in November. But I've kind of been a doubter of that narrative because it was like this really crazy up and down on the PCE that kind of triggered bonds, and then ultimately yields have come back down. What do you think about this?
Yeah, I think there is something to it. I always look at the quant and try to come up with a fundamental narrative that could perhaps explain it. And one of the things that makes sense to me is if, as Trump's likelihood of winning starts to increase, and that corresponded to the higher rates, investors were looking at two things. They were looking at the embargo, or at least some sort of tariff on foreign trade, and also a restriction on immigration, which would, start to crimp the labor force growth, both of which would likely result in higher inflation, maybe down the line. At the same time, Trump, who has already said he's not going to reappoint Powell, would likely put in a very dovish Fed chairman who will push interest rates down in the front end, and that could start to create a steeper yield curve, and we see yields go up in the 10-year and beyond.
So that part in particular seems to resonate with me, as he's made it clear he's no fan of Jerome Powell at this point for whatever reason. But can the economy, are we still in a point where it can rev back up if policies do shift dramatically, Jack? Just real quick. I mean, or the writing hasn't been written on the wall for the economy 6 months out?
Yeah, obviously we're seeing weakness in goods sales. A myriad of products are on sale now at Walmart and Target and Costco and other places. But no, I don't see that as the death knell of the economy. I think that with Trump, going back to that, extending those tax cuts, that could propel a lot of incremental demand. Keep in mind, the top quintile of earners account for 40% of all spending. And I would argue probably a majority of discretionary spending. And so these earners probably already have a home, so they're not on the outside looking in there. They have the income, and they have housing assets in the housing market and in the stock market. And they're likely not having to rely on childcare, which of course is growing at a much higher rate than inflation. So I think that that group, 20% of the households, will likely keep this economy together.
All right, good stuff. Thanks, Jack. Good analysis. Love the charts. Appreciate the time as always. Good to catch up.